Good evening, everybody. Thank you for that presentation. Tonight, look, it's been a challenging 12 to 18 months in the finance industry. I'm sure everybody here, whether or not you've bought to buy a property or bought to buy an investment property, might have experienced some ups and downs with a home loan application. I just thought it'd be nice to give you a bit of an insight on what's changing. It's not all bad news now. Probably over the last month or so, we've started to see some positive shifts in the way in which banks are assessing loan applications and changing their policies to improve the process and make it a little bit easier to obtain finance. A little bit of background about myself. When I finished school, I started at the ANZ Bank, worked in mortgages, funnily enough, ringing up customers that were just a few days behind in their loan repayments. So I was working making negotiations for people to catch up. By the end of it, I was looking after a call centre that was fielding phone calls from mortgage brokers, which is what I do now, following up the status of their application. And then in 2011, we started this business. So we've grown over the years. We started off just on our own and now we've got a sizable team. Just to give you a bit of an idea on what's happening in the general economy, I'm sure you're all well aware, interest rates have been coming down, right? It's really pleasing to see that over the last couple of months, interest rates have come down about 0.5%. The banks have passed on around about 80% of that interest rate cut. Some will come out and pass on the full 0.25 when it generally happens, and then perhaps the next time round they'll pass on a smaller amount, whether it be 0.2 or 0.19. But as an average, they've passed on nearly 80%, or just over 80%, sorry, of the recent rate cuts. So that's really promising, and I think it's certainly sparked a fair bit of interest in the home loan space, and I think that's represented by the number of people that you're seeing at auctions, you're seeing it open for inspections, and certainly the number of inquiry that our office is receiving. What do we see happening with rates in the future? Everything we're reading suggests that it looks like they may come down again. It might be hard to believe given that they're at record lows, but that's what the experts are predicting now, and it's what we're reading. House prices in Melbourne we've seen certainly stabilise over the last number of months, which is a pleasing sign, and I think that's based on, again, the market's definitely stimulating. What's happening with the lending environment? Lenders are really, I shouldn't say struggling, but they're certainly in the process of adapting to the changes that they're being forced to make by APRA, who govern or regulate our lenders. One of the really big shifts and one of the most positive shifts that we've seen in the last probably 3 to 4 weeks is how the banks are now assessing customers' affordability in a positive light. Okay, they've changed the assessment rates, and that again is driven by recommendations or rules set by APRA, which we'll talk about in more detail. Never has there been a time, I believe, to seek quality advice when looking at obtaining a home loan or an investment loan. You really need an expert in your corner, I think, just to make the process seamless and give you the very best chance of obtaining an approval. I'm going to cover off on a couple of things tonight, so I don't bore you to tears because our topic's not overly exciting. But firstly, borrowing capacity. That's probably been one of the hottest topics and one of the most confusing topics in our industry over the last few months. You know, customers' borrowing capacity from where they were 2 years ago or 3 years ago took a massive hit. You know, your circumstances may not have changed, but the way in which banks were assessing affordability reduced customers' borrowing capacity substantially. That, however, is starting to change and improve, right? So way back in 2015, the major shifts were HEM, which is the way in which banks assess the customer's household living expenses. 30% was the assessment rates, which we'll talk about shortly, which is the rules and the way in which banks have to assess affordability set by APRA. And 10% were haircuts on income. So what I mean by haircuts on income, a really good example is a real estate agent. They have a small base salary and a huge amount of their income is earned from commission. Banks used to just tally up or pool all that money together and use 100% of it. What they're doing now is they're saying we'll use 100% of the base salary, but we're only going to use 80% of the commission that they're earning. all right? And that goes with a lot of tradesmen in the city that work on big building sites where they earn a lot of allowances and things like that. So that's had an adverse effect. What the banks were doing, so set by APRA, loans, even though you were paying interest rates of say 4% as a rule, loans were being assessed at an affordability rate known as an assessment rate of between 7.25 and 8%, depending on the bank. The minimum assessment rate set by APRA was 7%. So every bank, even though your payments, like I said, well, you know, if you did a budget on paper, it would always work. And if you approached a bank, you perhaps mightn't understand. You know, you look at it and you think, this works comfortably, I can afford this, but this is how they're assessing what the payments are actually going to be. What's changed is that with interest rates falling, the market probably being not as there's not as many people being in the market looking at properties and finding it difficult to obtain finance, APRA's come out and changed that minimum assessment rate. So that minimum assessment rate now is 5.5%. All right, so that's substantially less than the 7.25s right up to 8% that the banks were using. Most banks now, except for really one that I can think of, which is ING Bank, have changed their assessment rates and are assessing anywhere between that 5.5% to 6%. So that is something that has probably added the best part of about 10% to a customer's borrowing capacity in the last month without their circumstances changing at all. So that's a significant increase given that we've only seen it dropping. So to see it come back the other way is hugely advantageous for customers out there looking to buy, whether it be their owner-occupied property or future investment properties. It had a huge impact on investors, and the reason being is if they're looking at an assessment rate of 7.25 on multiple investment loans, was really having an adverse effect on their borrowing capacities. All right, so that's something that's changed for the better. And that graph at the bottom sort of shows, you can see now that the HEM changes and the assessment rate, well, the assessment rate's contributing to about 70% of the increase in what customers can now borrow. We're nowhere near the level that we were, but we're starting to bounce back just a little bit, which is nice. The other key change is living expenses. Now, boy, oh boy, this is where it's all happening right now. And there's a whole heap of uncertainty around this, and it's even published in the papers today about living expenses and what's going to happen with it. Back 24 months ago or 3 years ago, a bank would look at it, let's just use an example as a couple with 2 dependent children. They'd look at that HEM, that industry benchmark or that housing benchmark, and say if you're a couple with 2 kids, your basic living expenses that we would consider would be X amount. It was a flat rate. That didn't look at whether or not that one couple in the same boat was sending kids to private schools. As you know, those expenses are far higher or far greater than if you were sending them to a school in the public system. But yet that customer could borrow the same amount of money. So I think these changes are for the better, and they're driven by the legislation changes around responsible lending. This is just an example now of the fields or the data that we have to collate from our customers when putting in a loan application. We have to go through their childcare costs, personal care, education, groceries, insurance, medical expenses, utilities, whether that be for owner-occ and investment properties, entertainment, phones and connections, transport, rents, and a whole heap of other expenses. An example would be private school fees. So we need to go through each and every one of those categories for every bank and put a number in each and every one of those fields. It becomes even more detailed than that because the bank's now just not taking our word for it. We can't sit there and say, okay guys, let's run through this budget now or send it to you in advance. The bank won't take our word for it. What banks are doing now is that they're asking for a copy of your last 30 days and some banks 3 months of your day-to-day transaction account statements, and they're cross-referencing your expenses via your statements with what you're declaring as your living expenses per month. So you can imagine the can of worms that can open up, and the questions that we have to go back to our clients to because we're getting questioned from the banks, and that results in a much longer process in obtaining a loan approval. And we're only at the tip of the iceberg with this. This will continue to evolve. We're starting to collate the information or we're making the process a little bit easy for our customers. Our office prescribes to an online platform known as bankstatements.com, and there's 2 or 3 of those, and we can help you collate that information via this online tool that can analyse the spending on your account. So we're starting to improve our process, so it'll speed up the whole loan approval process and make it a little bit better. But this is where the delays and the constant back and forth, whether it be with your branch or your broker, is stemming from. So there's a heck of a lot in this. Other important changes. Now this is really important one, the top one for investors. If you're looking to cash out equity in a property to perhaps use as a deposit to purchase something else, okay, banks are now looking at seeking evidence of what that money's going to be used for. Back in the day, if it was, $100,000 or $200,000, we could just say that the customer's going to use it for future investment purposes, and that was just in writing on our submission notes. But now they're asking for evidence of that. So what that might be is that if you're looking at using the equity to buy an investment property, right, they may want to see a copy of the contract of sale of the property that you're going to be buying. If you're looking at improving a property and doing some renovations to the property, they may now want quotes from all the builders and all the tradesmen that are actually going to perform those works. So it's not as simple as just a comment of what you intended to use the money for. The other one for funds for future investment, so buying the next property as well. So not only do we have to show evidence, we need to show affordability that you can actually service that future investment loan if you're looking at financing that property as well. All right, so they're going to do an assessment not on just you accessing the deposit, but accessing and settling and making sure that the end opportunity is affordable for you guys. So they're doing an overall picture. The other thing to consider now is the difference in interest rates. As you're probably aware, being investors and property owners here, there's a big discrepancy whether or not if you're considering paying principal and interest or interest only on your loans. Okay, interest-only loans, there's a little bit of an appetite coming back to lenders and banks now because the caps in which, well, they were restricted to the amount of interest-only loans that they could have in their loan book or approve, but those restrictions have been lifted. They haven't altered the interest rates all that much, but they are a little bit easier to obtain. Okay, so the investment strategy might be beneficial to make principal and interest payments, and the payments may not alter that much because the rates are so much less. Okay. Another thing to consider is your borrowing capacity is actually higher in the bank's assessment of affordability if you have a principal and interest loan. Now, on paper, that just makes no sense because your payments are much higher, right? But what they're doing is that they're looking at what your principal and interest payments are going to be upon expiry of the interest-only term. So an example of that is a 30-year loan term, an investment loan interest only for the first 5 years. They're looking at what your principal and interest payments will be over the remaining 25-year term. So on paper, again, the budgets work, and it can be a little bit confusing when we turn around and say, look, unfortunately, you won't qualify for a loan of the amount you need. The other thing to consider is the way in which banks they have risk appetites based on certain postcode restrictions in certain areas. All right, so they may say, okay, out in some banks might be, out say, pick Alexandra, for instance, which is a little bit out of Melbourne, up near Lake Eildon. They might say the maximum we'll lend on any property in that area is 80%. The mortgage insurers won't do it. Same with inner city, in the CBD. Banks used to really comfortably lend 95% of the value of properties. Okay, that's being cut back now, and that's really restricted now. So they're reducing the amount based on certain postcodes. The banks do have a list of postcodes. We can search them up and assess what lending they'll do in certain areas, and they're all different, completely different. Property size, so for investors looking to buy apartments, you need to be conscious of the size. Now, again, it's nothing to be too afraid of, but it's making sure you're talking to the right people. If you went to the National Australia Bank and said you wanted to buy an apartment that was 45 square metres, they'll say no, it's too small, doesn't meet our requirement. But with NAB, for that example, if the apartment's about 36 or 37 square metres, but there's a car park on title, they'll include the size of that car park in that scenario. And their minimum's 50, so the deal would work. But there are lenders like Commonwealth Bank, who's a prime example, for smaller apartments that are under 40 square metres, that will lend you the money up to 80%. And it doesn't matter what size it is. We've financed apartments that are 27, 28 square metres. So again, it's being conscious of that. Title restrictions, you don't see that too much in this area. But what I mean by that are titles like company share or stratum, S-T-R-A-T-U-M, banks will lend you generally up to 85%. Okay, but then again, some banks won't. So if you're speaking to the wrong lender, they'll just shut that transaction down. So again, it's making sure you're speaking to somebody that's armed with all the information. Age restrictions. So this is about the age of the applicant. Okay, this is something that's pretty new as well. It's nothing to be too afraid of, but if you're, say, 60 or 70 years of age, you're looking to finance your owner-occupied principal place of residence, you need to demonstrate an exit strategy, because most likely you're not going to be working upon retirement. Okay, so they're going to want to show how you're going to make payments on that loan or clear the debt when you move into retirement. Okay, that can be the use of superannuation, but it's just something that needs to be addressed at the start. If you're an investor, it's not really a problem at all, because your exit strategy is to sell the property and clear the debt. Right, so it's nothing to be afraid of as an investor. Changes in the guarantor space. That has changed significantly, and that's an example of where a parent might like to help out their child purchase a property. Okay, so what in that instance would be, whereas a parent would help out their child by allowing them to leverage equity out of a property that they own. Okay, banks now have really strict requirements around that, how the guarantors must seek independent legal advice. A lot of banks are not allowing parents to use their owner-occupied residence as that extra equity. It has to be an investment property or something else, or money in a term deposit. So that's a changing environment all the time. This is something that's incredibly important. And this sort of, I was just thinking about when you're talking about, they were talking about property managers and vetting customers, not so much payment history, but payment history and their conduct with in previous properties. What this is banks are now sharing data between themselves more than ever before. And it's known as the Common Reporting Standards. Now, this is brand new. It was allowed to be done as of the 1st of July 2018, but banks have only just started doing it. And I've had it impact a few customers of ours in recent times. So what they're doing is that if you were applying for a loan with ANZ and you had a credit card with CBA and you'd kept your payments up to date for the last 30 days or 90 days, and you showed them that statement, everything looks really good. But if 12 months ago you'd missed payments or you'd made late payments on that credit card, that data is now being reported through to the credit reporting agencies. So the banks are going to know. So it's never been more important than ever to ensure excellent conduct on all your credit facilities, whether it be credit cards, personal loans, everything, because this is only just started, and this will become a very, very big thing because banks are doing it and they're starting to use this tool. So this will just mean that there might be more customers seeking loans through perhaps other lenders that look at non-conforming transactions. Okay, so it's just something to be mindful of. The amount of information being requested has increased significantly, so that's verifying living expenses, okay? That's all based on the extra info that the banks are seeking to ensure that you're declaring the correct amount of living expenses. The next one, the process for obtaining an approval. So I'll go through this reasonably quickly because most of you are probably familiar with it, but it's never been more important, in my opinion, now to ensure that you're having or putting in place a pre-approval prior to a purchase. It might shock some people here, but customers do go out and buy without any pre-approval or any consultation with a bank or lender. The other thing to be mindful of is that there's two types of pre-approvals. When we lodge an application, whether it be through our office as a broker or a brokering office or a bank, once it's lodged, the banks provide a decision on that application within 20 seconds. And that could come back with an automated pre-approval. So they've checked your credit score, They've looked at everything that's available to them on the computer in their databases, and they've said, yes, this deal works. That pre-approval, in my opinion, is not worth the paper it's written on. They've not looked at your pay slips, and that could be an instance where the banker or the broker's put in wrong information because a customer earns base salary, commission, allowances, so there might be a data entry error there. They haven't looked at the conduct on the accounts, and they haven't verified your living expenses, so they may not agree with them. So you need to be very careful at ensuring that you're going through the full pre-approval process, which will take at least 3 or 4 days as a minimum, to ensure that the pre-approval that you're issued with is something you can confidently take to auction. And we've seen it many, many a times, and I've seen it myself this week, where a customer dealt with NAB directly, was provided a pre-approval for $518,000. The living expenses weren't anywhere near what they actually were. And if that client had purchased at the auction, there's no way that pre-approval would have stood up. And that's going to give that poor person a heart attack. It's really scary. So you just need to be very careful. If someone gives you a pre-approval in 30 seconds, it is just no good. So just be mindful of that. Also, having the pre-approval will place you at an advantage, of course, if you are putting in offers and you compete, if we do a pre-approval for you, you don't need to put in subject to finance into the contract. You can confidently bid confidently or put an offer in confidently that's not subject to finance to give you the best chance of winning the property. Also, having a full pre-approval in place will save you time between the offer that you make and obtaining full approval. All we really need is the contract of sale. We can order bank valuations up front now at no cost to the customer, so we can get them back a lot quicker, which also allows you to offer quick settlements, whether it be 30 days or 45 days. Current interest rates. So this is just to give you a bit of a feel of some of the rates that are out there and what's changed. So you can see there that for an owner-occupier, just an average variable rate out there at the moment, there's some as low as 3.05%. These are on our panel of lenders, so they're lenders that you will have heard of. They're not ones that you've never even heard of before. You can get 2 and 3 year fixed rates now into the 2s, okay? For investors, principal and interest rates at 3.5%, fixed rates at 3.39%, and then of course you can see the higher rates over there for the interest-only products. All right, so interest only is definitely more expensive, but they've all dropped now to under 4%, which is really promising. Okay, so they're quite good. What's next, or what do we see happening next? The changes in the lending environment are starting to impact house prices in a positive way, and I think that's just because we're starting to see more and more people out there. We've had a huge spike in interest in our office. We were doing a lot of refinancing for customers, but now with these changes, people are back purchasing properties. Like I mentioned before, the complexities around lending, it's never been more important to seek out really professional and qualified advice, especially like that pre-approval scenario that I gave you. That'd be terrifying for anybody, and it's just undue stress, when these types of things are supposed to be fun, really. Finding the most cost-effective and suitable options. So that is, again, looking at whether or not principal interest might be a better way than interest only, because traditionally we've always been about interest only on investment. It might be time to start looking at changing that, given that the rates and the costs are so much more cost effective. But other than that, if anybody's interested in a home loan or investment loan health check, our contact details are all in those bags, and we'd be delighted to help. That was all I had tonight. Thank you.